What's going on, everyone? Welcome back to the channel. In this video, I'm going to go over my top 5 stocks for the month of April 2021. These are the best buy stocks that I screened through based on news, fundamentals, and technicals that are all very different and specifically interesting to play right now for the month of April 2021. A couple on my list I've covered on the channel before, but most are new, so you're gonna wanna stick around and listen to my full analysis on each of these companies. I'll go over the key numbers, recent news, and why I expect them to grow and make you some money. Let's not waste any time and jump into these stocks that I think have very high potential to outperform the market over the next month. Real quick, all I ask is this video took a lot of research, so if you smash the like button, it would mean the world to me. All right, first opportunistic stock is Carnival Cruise, ticker symbol CCL. Carnival is currently valued at $29.6 billion. Their price to sales is just over 3, and they're trading at just over their 50-day moving average. The cruising industry has been hit the hardest, along with travel with restrictions and the pandemic. Carnival has used the pause in seagoing operations to improve their fundamentals. The cruise line has rid itself of 16 less efficient ships, and the most recent one was Pacific Princess, the smallest ship in its Princess Cruises fleet. Carnival plans to dispose of at least 19 ships. The 19 ships represent about 13% of pre-pause capacity, but only 3% of operating income from 2019. In addition, Carnival slashed its monthly cash burn to $500 million as of the fourth quarter, and that is down from more than $700 million in the third quarter. As more people get vaccinated, cruising will eventually open back up, and I believe there is a lot of pent-up demand. The stock recently closed at $29.79 with hopes that we might have cruising come back this summer. The CDC has shot down that hope, but later this year at some point we will get some news that cruising is available, and I think stocks like CCL will rise. January 1st, 2018, CCL was $71.61, and we're about 65% down currently from those levels. If in the next year the situation continues to improve, we can see Carnival go up to at least $50 per share on investor enthusiasm. The next stock I have on the list is Teladoc, ticker symbol TDOC. This stock is the future of medicine. Just last month, Teladoc reached $308 per share. The shares currently are a fraction of that, trading at $177 per share. The market cap is $27 billion. Now, the global telehealth and telemedicine market is expected to grow at a compounded annual growth rate of, wait for it, 37.7% to reach over $191 billion by 2025 from an estimated $39 billion in 2020. Long-term growth in telehealth is insane, which is why Amazon decided to enter the virtual health market. But Cathie Wood scooped up more shares of Teladoc after the shares dove from the Amazon announcement, so this growth stock seems to be suspiciously cheap right now. It's currently standing at a whopping $70 below the 50-day moving average. Another lesson learned over the past year has been the ease and utility offered by telemedicine. The ability to see your telehealth provider without ever leaving the comfort of your own home has many implications that I think will last far beyond the pandemic, in my opinion. The revenues beyond the pandemic will continue to rise as everything will continue to shift digitally. Bears will say that once life returns to normal, that the need for telemedicine will dwindle, but the evidence suggests otherwise. A survey of 2,700 patients reported that 90% of respondents said the quality of care during digital visits was as good, if not better, than the physical office visits, while 60% said that they plan to use telehealth solutions even more so in the future. Teladoc was already generating impressive growth, but the pandemic kicked its results into high gear. Revenue grew 98% year over year in 2020, with robust growth in patient visits, and they soared 206%, which is remarkable for the company. Now, the company's net loss also did jump, affected by a combination of acquisition-related expenses and income tax complications. Backing out those one-time charges resulted in adjusted EBITDA that increased 298%, so the growth numbers still looked very attractive. The company also acquired Livongo Health, the leader in managing chronic conditions via connected devices. There are more than 147 million patients in the US alone who have at least one chronic condition. Providing patients with strategies to help control these conditions is a rare win-win, improving quality of life while lowering the cost of healthcare for those dealing with diabetes, hypertension, weight management issues, diabetes prevention, and behavioral health. Post-merger, Teladoc's addressable market size is estimated to be more than $64 billion. Given its full-year revenue of just over $1 billion, there's a long and lucrative road ahead for Teladoc. Cathie Wood added to already sizable Teladoc holdings last week with ARK Next Generation Internet, ARK Innovation, and ARK Genomic Revolution ETFs all adding some shares. This brought Teladoc to 4%, 6%, and 7% respectively of their holdings, making it a top 10 position in all three of the funds. Next stock is NIO. Now, NIO shares continue to slide to levels investors saw back in November, and the market cap is currently $54 billion. Now, this stock is currently under $35 per share, which I think is a steal, and the average analyst has NIO at an average price of $56.73 per share. NIO's positioning as the golden EV child of China is a selling point for investors, and they have some key advantages like battery swapping technology that is truly innovative and different from companies such as Tesla. NIO is adding products to their catalog and expanding beyond just vehicles. NIO Sedan is ready to sell on the market by the end of year or early next year of 2022. Now, one concern investors do have is a shortage of chips. This is part of the reason NIO has sold off so hard, since they may have a limit of resources available to them for mass market production. However, there is something that I'm very bullish about that it needs to be addressed. NIO is confirmed to have a relationship with Nvidia for a contract, which will help them have access to a lot of semiconductors. China is also the leading market in semiconductors, so this gives NIO a huge advantage over the EV companies that are not based in China. The company said that the recent shutdown that they're having with a little bit of their production line will reduce first quarter deliveries to approximately 19,500 vehicles compared to the prior estimate of about 20,000 to 20,500 vehicles. Even with the lost production, NIO's new estimated first quarter production levels of 19,500 vehicles would represent more than 400% growth over deliveries reported in 2020 first quarter. If NIO continues to grow its deliveries, even with some supply shortages, the company's stock will outperform in the long term, and I think it's a very interesting play right now at just under $35 per share. The next stock I have on the list is Palantir, ticker symbol PLTR. Cathie Wood's ARK Innovation ETF added 1.2 million shares of Palantir as the stock slipped to its lowest price in nearly 4 months. PLTR has a market cap of $41 billion currently, and the stock is trading around $22 per share. The data company has fallen 17% in the last month amid a lockup expiration that prompted insiders to take some profits and sell their shares. Now, what did Cathie Wood do? Her flagship ETF fund added 1.2 million shares of Palantir on Wednesday alone. Data analytics is my favorite area to invest in right now, and I know we will see some tremendous growth in the future. The massive volumes of information generated and used for decision making in business today fuel the booming business of data analytics and big data companies. Big data companies combined with analytics technology help businesses achieve valuable insights into many areas. This company has one of the best chances to 10x long term, and at the key support levels this stock is at right now, I think it is a very interesting play and a strong buy for April. Next stock that we have here is LMND, ticker symbol LMND. It's down 53% from its peak stock price back in January. This is a growth stock. I think it's a very interesting play, and the fact that it's down so much is something that I really want to discuss here, and it may be the stock that I am most bullish on right now. The market cap is just around $5 billion, and the stock is currently sitting at $85 per share. The high-tech and potentially disruptive insurance company is still a name worth looking at, especially at this time. LMND has reinvented the insurance shopping and claims reporting experience. It leans heavily on artificial intelligence chatbots to serve up quotes, and the claims process can sometimes be completed the same way within minutes. I've actually insured my current apartment with LMND Insurance, and I love the simplicity of the app. LMND initially launched as a platform for renters and homeowners, but recently they actually rolled out policies for pet owners as well. Consumers, primarily young renters and first-time home buyers, are flocking to LMND, which has me very bullish that they're capturing a big part of the millennial market. It's seen its active policies climb 56% over the past year, and now it's serving over 1 million customer accounts. Premiums paid per account are up 20% on average, and over the past year, its gross loss ratio keeps improving alongside the platform's scalability. LMND would have to roughly double to get back to their early highs. This is an opportunistic time to consider adding LMND, Lemonade, especially as the stock has been cut in half. Here's a chart of how fast Lemonade's revenues have been growing. Although their losses have been growing, this is a classic technology stock situation and has me even more bullish since technology stocks typically are valued by looking at price to sales ratio, which means sales is the most important ingredient for Lemonade right now. Lemonade is disrupting traditional insurance companies. The explosive growth potential along with Lemonade's low enterprise value of $5.3 billion makes it a lucrative takeover target for larger insurance companies. It's also a lucrative takeover for growing fintech companies that want to diversify into the insurance business. So either way, I see Lemonade as a growing stock to invest in now or an attractive takeover target for the future. If you like this video, I post daily stock analysis and give early access to what I post on YouTube so you can get into these stocks before others if you're part of the Patreon in the link below. Thank you so much for watching, and make sure to check out my options playlist right here. It's guaranteed to teach you some valuable insights about options trading that you can apply to stocks that you already have. Make sure to subscribe so you don't miss a video, and I'll see you guys in the next one.